There we are. We are live, and we'll see people start to trickle in. And remind me where exactly the move was to.
New York.
What part?
Manhattan.
Okay.
Yeah.
Got it. Had you spent any time there before, or serious time there before?
Yeah, I lived there in my 20s for 5 or 6 years, and then was in Miami for like 11 or 12. And so it's a homecoming, but it's very different, being no kids and single for most of the time.
I never lived in New York. I went to law school in Connecticut, and a bunch of my friends went down to New York, and I really wanted to and never got around to it. And then kind of got the advice that doing your first tour in New York once you had kids probably wasn't going to be the right move. I feel like if you know the place and you know what it's like, you can make that decision. But I wasn't going to schlep and drag my new family to move to New York. So I'll save it for once they're, off. I've told my wife, as soon as the kids are in college, we're making a run for New York for at least like part of the year. I don't know if I can convince her to move, but do some of it.
That's cool. That's definitely the move.
Yeah.
Go off to college and get yourself a pied-a-terre.
Yeah, exactly. Which is not that far away at this point. They're up there. It comes quickly. So I usually give people like 2 minutes past the hour to come in. I guguess do we have the chat here? Yeah, I'll just, as people start to trickle in, let us know you're here. We always see, Geoff, I know we kind of co-marketed this thing. We always see a number of familiar faces, and so I always like to ask folks to chime in and let us know who they are and where they're from, just to put some faces or names to the people here. So as people come in, let us know who you are and where you're from. I'm also going to create a little banner here. Remind me the main Arta URL, Geoff.
Artafinance.com.
That's right. So I'll just have that kind of, up when I feel like having it up. So we're at 2 minutes. I think we can maybe start to ease in, and then people will come in. So welcome everyone who's here, and for the folks watching it at home on YouTube after the fact. Most of you know I'm Geoff from Valur. I have also different Geoff from Arta Finance here with me today. And this is, I think, I don't have the number in front of me. I think maybe is it 39? I'll find that number shortly. Some large number of webinars we've done at this point. And we are now into what I think of as the second level of webinar, where we're talking about, Tanishka from my team reminds me that this is number 35, still up there. And we've gotten past the basics, right? We've talked to you all about what Valur does. We've talked to you about, the high level. What do we do in general for capital gains? What do we do for estate tax planning? We're now at the level of what are the slightly more advanced or more detailed types of strategies we could talk about, and let's dig deep and really understand them so that you, and very often we're talking to advisors, so your clients can take advantage of this stuff. And so today we're talking with Geoff from Arta Finance. We'll introduce ourselves in a second, but we're talking about ILITs, Irrevocable Life Insurance Trusts, which are one of the first stops for most families who are easing into the high net worth arena for beginning their estate tax planning journey. So like I said, I'm Geoff Love from Valur, part of the founding team, lawyer by background. You all have heard this stuff before. As you know, and we'll talk about this a little bit, Valur is on the side of helping you identify these strategies, evaluate them quantitatively, and then implement. And today we've brought in Geoff from Arta. Arta is a partner of ours with whom we've done a lot of this work and helped a bunch of their clients. So Geoff, you want to introduce yourself and Arta?
Yeah, absolutely. Thanks, Geoff. Appreciate that intro. As you mentioned, Valur has been an amazing partner to Arta over the last year. Valur has helped quite a few of our clients entering that high net worth level in terms of estate planning and looking through strategies. And we've partnered up specifically on ILITs quite a bit. So very excited to be here. I'm with Arta Finance. Arta Finance, in a nutshell, is a digital wealth management platform. So accredited investors and above can go online, create an account, and immediately start to access wealth management, very high quality wealth management products. So that's everything from alternative investments like private equity funds, venture capital funds, real estate funds, private credit, to liquid portfolios of stocks, bonds, and ETFs, to structured products, life insurance, both traditional and the one that we'll focus on today, private placement, all done in a really beautiful user experience. It's self-service when you want it to be, and you can always tag in an expert to help you get through any of the different concepts or strategies. So really cool platform. I've been with them for 1.5 years, and I encourage you to check it out. My background, I've only been in wealth management. I've been doing this since 2008. I've spent time at a large private bank. I've spent time in a hedge fund, and I've spent the last chunk of my career focusing on life insurance solutions for high net worth individuals. And I'm really excited to talk to you about it.
That's great. And I'll just echo, like Geoff said, we've helped a number of their clients. We've also sent clients their way to Arta. Arta is a fantastic platform for what I think of as the, pejoratively in the old days, we would have called it kind of the, the nouveau riche. It's the group that has just, arrived on the scene, often via their tech jobs, their high paying lawyer jobs, doctor jobs. It's the folks who are now earning really good money, starting to see that net worth grow, and it's a great platform. So we can all help you in various ways, and we'll definitely aim to do that here. Agenda for today is to talk about ILITs in the context of the broader conversation around the gift and estate tax exemption, which most of you are familiar with in general, but we'll do a little bit of a refresher there. We'll dive into ILITs, talk about what they are, how they work, who can benefit from them. We'll talk about getting into the weeds here a little bit on how life insurance interacts with both the income tax and the estate tax. And those are two separate sides of this coin, but they do both come into play. We'll talk about the practical aspects of ILITs around setting them up, funding them. We'll talk about PPLI, which Geoff mentioned. This is an advanced strategy, typically for those who are really entering the high net worth space, or level, but can be very powerful, and we do a lot of it. And then we'll do a quick case study at the end. As you all have seen in the past on these presentations, the idea here is to give you a directional sense of how these strategies perform as compared to not pursuing them, both on the income and the estate tax side. So that's the idea, and we're going to aim for 45 minutes to an hour. We'll see how this goes. That's kind of generally where we try to hit. So first, as I said, a quick refresher, or for some of you maybe a primer on the gift and estate tax. I'm sure everyone is at least aware of the gift and estate tax, but exactly how it works is often a little bit foreign. And so very quickly, the idea here is that everyone who's subject to the US tax system and the estate tax rules gets to give away a certain amount of money during their lifetime and when they pass away. And then anything they give away above that level will be subject to some tax. And that'll typically be a federal gift and estate tax, and then potentially in some states, a state level gift or inheritance tax as well. So the gift and estate tax is the tax that you'll pay on transfers to somebody else, typically the next generation, but not always, after you've used up that exempt amount. And so that lifetime exclusion is the amount that you don't have to pay tax on. These rates are 40% at the federal level. They can reach 52% federal and state. The individual lifetime exemption right now is $14 million. It's scheduled to be cut in half at the end of this year. But as many of you know, this is part of the conversation around the various tax reforms that are happening in Washington right now. The latest proposal is to extend that $14 million exemption, in fact, grow it a little bit, and then index it to inflation and make it permanent. This would be a reasonably large change from the current regime of kind of wildly swinging exemptions. And so it'll be helpful for planning. It doesn't really change fundamentally the ball game. It's going to mean that the first 14 or $15 million is free of tax. And then everything you give away after that is going to be taxed. And you can see some numbers here. If you're giving away, an extra $1 million above that 13.99 today, well, it's going to be 40% tax at the federal level, 400 grand. If you give away 10 million bucks, that's $4 million of tax. And so in some ways, just wanted you to understand this, but also to highlight the sheer magnitude of the potential tax and the potential savings here. What we're talking about today is, for many people, the first step on the estate tax mitigation road, and it can be really, really powerful and important. If you can find a way to move 10 or 50 or $100 million out of your taxable estate, you're saving millions to potentially tens of millions of dollars on this tax. And so it's just really, really impactful and worth getting started on, very early, which is what we're going to be talking about today. So Geoff, I guess before we turn to ILITs, just to pause for a second, from the advisor's perspective. So I know for Valur, people come to us when they're at least already thinking about this sort of planning, right? Either the advisor has told them you've got a net worth where this is justified, or they've done their research, they've gone to Google, or they've gone to ChatGPT or Gemini, and they've looked this up and it says, hey, you should be starting to think about this. So we see people who are primed for it. How do you approach the question of when it's time to start this sort of planning? How do you talk to people about or kind of get them primed and ready to start digging into these topics, which are admittedly a little overwhelming, a little complex? Valur makes that easier, Arta makes that easier, but it's not something that's easy to dig into. So how do you kind of broach that subject or break the seal?
Yeah, that's a great question. I mean, almost any, certainly any life insurance discussion we're having with clients, and it's almost regardless of their current net worth, that they should be aware of this mechanism, which is the lifetime exemption. And the reason that we at least make them aware of it, even if, let's say, they only have a $3 million net worth, net worth, or they're building their wealth, they're young, but they're ambitious and they're making a lot of money, and one day they're going to get there, is twofold. One is that exemption amount, which let's say it's 15 million and it gets passed, is going to grow at inflation. Chances are, if you've made it to a point where this is in your periphery, you're going to grow your assets much faster than inflation. So even a lot of folks make the mistake like, oh, I have 8 million of net worth, I'm fine. But if you're 45 or 50 and you project that out another 40 years, you're growing your assets at 4 or 5 or 6% net. The estate tax exemption is only growing by inflation. You're gonna have a taxable estate. So it's good to be mindful of it. It's good to be aware of it, even if you haven't met that threshold. I mean, it's also a reminder, and you referenced it too, is how estate tax exemptions have fluctuated over different political regimes. I mean, it wasn't too long ago that we were contemplating the exemption going to 3.5 million per person. And so it's good to be aware of the mechanism. It's good to have an eye on what you have now versus that level. And we're always kind of bringing that up. And I think that's something that I think people don't focus enough on, is this growth aspect of like your estate's going to grow faster than the exemption is going to grow.
I'm totally with you here. We often get posed the question like, when should I be thinking about this? People are, like I said, are coming to us. They're already primed, so they're a little more open, but they're still asking like, am I ready? And I just have a calculation in my back pocket it takes 30 seconds less than that to do, but it's nice to have. To your point, someone with $8 million today, and let's say they're 40, and let's assume they're going to live another 50 years, just a nice round number. They're healthy, high income. They're going to live that long. If they beat inflation by 6%, which is low by historical standards for just run-of-the-mill public equities weighted investment portfolio, over 50 years, $8 million is going to turn into $150 million inflation adjusted. That's an insane number for most people to hear. Right now, they're going to spend their money. Maybe they don't get 6% over inflation. Maybe they don't live 50 years, or they give it away before then. There are a lot of mitigating factors, but just back of the envelope, if you have 5 million today and you're in your 40s, if you have 8 million or 10 million or even 20, we're talking about really significant wealth that is going to be well over this threshold by the time you're done. And so when we remind people of those numbers, it becomes pretty clear, hey, I got to get started on this stuff.
Yeah, right. Yeah, absolutely. And ILITs are the, in a way, and you mentioned this as well, like the first stop, because it doesn't really require a big gift of assets per se. You're gifting whatever the premium is going to be for that, but you're creating this legacy asset and letting it sit outside your estate, which is really, it doesn't take much to create an outside of your estate legacy asset.
That's right. So with that in mind, why don't you just dig in here and tell us about ILITs and how they work at a high level?
So taking a step back also into just what is life insurance, so we have a quick baseline on that. Generally speaking, there are two types of life insurance, and one is term. Term is, a very inexpensive, relatively speaking, policy that has an expiration date. It has no investment component. It's more akin, interestingly enough, term life insurance is more similar to car insurance, health insurance, home insurance than it is to permanent life insurance. Term is a completely different product. It's there to protect you against an unforeseen event, just like kind of those traditional other insurance lines are. And then there's permanent insurance. And permanent is the umbrella for a bunch of terms you've probably heard: whole life, universal life. They all sort of get lumped in together. Permanent insurance is interesting because it's maybe the only insurance product that is, if it's kept in force, is certain to pay out a benefit, because as we all know, two things certain in life, and that's death and taxes. And so because it's a permanent insurance product, and there will be some sort of benefit paid out by the insurance company if it's kept in force, it has a completely different mechanism in order to buy it, to manage it, to invest within it. And it creates a lot of really interesting opportunities, particularly for high net worth individuals, and then extra particularly for high net worth individuals that are using it as an estate plan.
Yeah, it's funny that you use the construction around death and taxes, because a lot of what we're talking about today is how to make the taxes piece of that not inevitable, right? And that's right. The combination here, right? By doing life insurance, we can find ways to move the income out of the income tax bucket. And then when we combine it with ILITs, which you're going to talk about next, we can attack the estate tax side too.
Exactly. Yep. And so that the life insurance by its nature as a product, whether you hold it in your personal name, a revocable trust, an LLC, an irrevocable trust like an ILIT, is income tax free. So any sort of benefit paid out does not go against any sort of income or is income taxable. However, any death benefit proceeds that are paid out if you own it in your estate, so if you don't own it in an ILIT, are going to get added to your estate. And so all of a sudden, let's say you have a $10 million life insurance policy that you own in your personal name. When you pass, that $10 million turns to cash. It goes to your beneficiaries, which is great. They get to use it. But that 10 million gets added to your estate, and then that creates some sort of estate taxability if you're over and above the exemption. What an ILIT does is it takes that policy. You still enjoy the protection of knowing it's there and the income tax benefits of owning it. But when the benefit comes in, it comes into your family income tax free because it's life insurance, and it doesn't add to your estate, and therefore it's estate tax free as well, which is a really great solution for a lot of families to put up a little bit of capital now and have that larger payout event outside of their estate in the future. And there's this bullet here on the slide. It's best for folks that who aren't worried about liquidity. The reason being is once you put a life insurance policy in an irrevocable trust, you've effectively irrevocably gifted it away from yourself. And so you just have to be very careful and mindful in structuring it, and know that it's not something you can call up and grab money out of when you need it. And so that's the trade-off of not paying estate tax.
Totally. With that trade-off despite that trade-off, we have this other bullet point, which is a pretty broad and bold claim, which is that an ILIT can make sense for any high net worth family that expects to be over the estate tax exemption. That is a strong claim, but I think it's clear Let's talk just for a minute about why that is. Like, what we'll talk about some of the downsides down the road, but in your practice, as you're thinking about this, and like you said, this is one of the first things that a family might consider. Like, why is this the thing that everyone with a high net worth should be starting with, I guess?
Yeah, great question. I think, the basics of that is when you reach the level where you're at a net worth or a, pathway that you're going to be over an estate tax exemption, you're for the very likely already making capital allocation decisions that are for some entity or individual or child after you're gone. Chances are, if you're going to be over the estate tax exemption, you're leaving something to someone. And as you think about allocating your investment dollars to stocks and bonds and real estate and alternatives today, you're really making a lot of those decisions that will ultimately benefit the next generation or some cause after you're gone. And so it's really, once you start thinking about life insurance that way as an allocation of your dollars alongside these other things, and it fits in that legacy bucket where, okay, I'm making these allocations to private credit or private equity or stocks and bonds. They're going to grow for the benefit of my kids. Why not take a portion of my portfolio and lock in a certain death benefit amount that's instant liquidity when I pass away, arguably the moment my family needs it the most, and can help handle any sort of liabilities like estate taxes, mortgages, et cetera.
I think
it becomes a tool alongside these other kind of investment toolboxes as thinking about a way to allocate capital. Less about paying premiums like you think about traditional insurance, more about allocating dollars for the future.
That's right. And I think that's a good insight. This is, the first question really is, how do you want to allocate your money? The second question is, should you be doing so in a way that is attacking the estate tax issue down the road? Or do you want to keep your money, not make those commitments? And then once you answer, yes, I want to do some of this estate tax stuff, here's why it should be ILITs in particular first. Taking a beat on that middle question, like, should you be doing estate tax planning? This is something that we talk about clients with a lot. The question is often, I'm young, I don't know my plans yet. I don't know how much I want to leave behind to my kids. I know I want to leave something, but I'm working at Google, and my net worth is in the mid 7 figures. I expect it to grow. Maybe my net worth is 10 million plus. I'm a director at Google now, and I'm doing very well. But I don't know what my plans are. Should I be doing estate tax planning at all? I want to tell you our answer, and then I want to just hear yours again for another minute or so. Our answer is, if you know you want to give something away, then yeah, you want to be thinking about this. And the second step of that is there are a number of strategies that you can pursue that are lightweight or not capital intensive today, like a simple kind of smallish ILIT, like a GRAT, which we're not going to talk about today, but it's another one where you're not really committing capital other than the gift amount, but you're getting a bunch of your money back. We're looking for these sorts of strategies that are lightweight, not a huge commitment of capital or of time or of mind share, that are helping people dip their toes in, start the process of moving money out of their estate because they know they're going to want to, without that big commitment of, for example, funding a $10 million IDGIT or trust fund for your kids. Is that kind of consistent with how you think about this for those early families?
Yeah, I think so. And I'll share 2 quick applications in that same framework. So we have a lot of clients that are in that, I'll call it $10 million, work at a tech company, doing well, young family, starting to think about estate planning. There's really 2 applications of life insurance in that world. One is the traditional route where, to your point, you commit a very little bit of capital, let's call it some portion of your dollars in premium, and that kind of locks in your current net worth in a way. You can put 1/20th of money in today to lock in, let's say, a $10 million permanent life insurance. So that for a lot of folks, that gives them the peace of mind of like, okay, I know I want to leave something to my kids. I don't know what's going to happen with the tech company I work for, or if I'm going to want to invest in a startup, or if I'm going to light the money on fire somehow. Sure. When I buy this permanent life insurance policy with a little bit of capital, I know that I'm locking in something for my kids in the future. It frees me up to make more, aggressive or interesting capital allocation decisions. So that's application one. Application two of the same family could be, well, I want to diversify away from technology stocks a little bit. I have been doing research into alternatives like private credit, private equity, and real estate. I also need to do something for an estate plan. So why don't we set aside 10% of my balance sheet, $1 million, allocate it to these private investments, which will diversify my portfolio, and have that be the funding source for the estate plan, which is where this ILIT PPLI combo really, makes a lot of sense.
Yeah, absolutely. So with all of that kind of wind up in mind, let's do a little bit of the details here. How do ILITs work? And then we'll get to the life insurance. There was a question from Dave Rosenblatt around fees and PPLI and all of that. We'll talk about that in a few slides. A lot of this is implicit and probably intuitive how ILITs work. We've been talking about it already, but let's just be explicit here. How do ILITs work? So you set up a trust, right? It's an irrevocable life insurance trust. It's a trust that is, all trusts are separate from you, the taxpayer. It's an entity. It's a legal entity that can own assets. You set up this trust with some ultimate beneficiaries, right? The ILIT is typically for the benefit of your kids. The ILIT receives a life insurance policy. As you said, the ILIT is the owner of the life insurance policy, and really importantly, it's the beneficiary. The ILIT pays the premiums. We'll talk about how you actually mechanically fund the trust to pay those premiums, but the ILIT is paying the premiums over time. The ILIT just runs for many years, and we'll talk about how you invest the money and all of that. And then when the insured person passes away, hopefully in a really long time, the trust gets the proceeds, right? So let's say you want a policy that's going to pay out $10 million inside of the ILIT. When the grantor passes away, the ILIT receives the $10 million payout. That payout, as you said, Geoff, is outside of the estate of the grantor because it's now in this trust separate from that person. So it's not going to be subject to gift and estate tax. And then the trust will now have that money and it will be able to pay it out to the beneficiaries of the trust going down the chain, who are typically the family, the kids, and maybe the grandkids of the person who set it up. And so it's a very simple thing. You set up the trust, you put life insurance in it, you pay for the life insurance every year or every however long. When it pays out, there's a big chunk of money, and it's tax-free, right? It's one of the closest things to magic that we do. I always say, I think I've said this in almost every webinar we've done, and certainly on calls. I'm a lawyer. I tend not to speak in absolutes. I try to be careful about this stuff. Nothing's a no-brainer, and nothing's perfect, and nothing's actually magical. This is pretty straightforward, and you can draw a direct line from not a lot of money to a lot of money tax-free. It's an easy win for most families, which is again why it's often the first stop. So I said I'd jump to this. How do you do this, right? You set up the trust, you put a life insurance policy in there. Typically, it's going to be a new life insurance policy, not one that you already own. You put the insurance policy in. Well, now you have to pay the premiums for the policy, just like you would any life insurance policy. How do you do that? There are a bunch of ways here. The bottom line is you can't pay them yourself, right? From outside the trust. You could, but it would be administratively a nightmare. It would be not optimized. There's no good reason to do it. So that's not what we do. Instead, typically what you do is either pre-fund the trust with cash or maybe an income producing asset that will itself pay for the premiums. You can do that at the outset, and as a result, you get that money out of your estate, and then it just pays the premiums. Or you can fund the trust every year, just with a cash gift to pay those premiums. It's entirely up to the grantor. It's very straightforward. There's nothing fancy here. We just like to touch on this because it's helpful to demystify. It's very, very easy to do. You just fund the trust and you pay it. Anything? I feel like I'm maybe being a little glib about this step, but it's not complicated. Anything you feel like you can touch on, Geoff?
No, I think the one thing that keep in mind, I guess, is when Geoff talked about the estate tax exemption and that lifetime exemption in the beginning, any kind of gift that you give to this irrevocable trust or any funds that you send in are going to count against that. So you just want to be mindful about the fact that you're using some of your exemption to fund this. You're getting this multiplier effect on the future. But I think that sometimes there's a bit of, I thought I'd only pay that. You have to still, document it as a gift, et cetera.
And part of that is that just thinking about overhead a little bit, often the question is, well, this is straightforward, but I've got to deal with it. It's going to be a lot of administrative hassle. No, Valur, working with Arta, but on this part, especially the Valur side, we handle that for you. We'll do your gift tax form. We'll do the filings. So you don't have to worry about this. But it's true, there's a little bit of overhead here behind the process that I described.
Yeah. But generally very straightforward. Agreed.
Yeah, that's right. Benefits and trade-offs. I think we can probably speed through the benefits here. We've talked about this. On the estate tax side, the life insurance proceeds outside of your estate, very straightforward. If ultimately you've put money in and you've used up that part of your gift tax exemption, and then the money grows and you've got $10 million in there now, that's all estate tax free. Very straightforward and the main benefit. Geoff, do you want to talk about the tax-free growth side of things, which is maybe more on your side?
Yeah, absolutely. And I'll get into a little bit more of the details in a subsequent slide. But one of the features of life insurance is that you have what's called tax-free buildup of value. So when you pay a premium into a permanent life insurance product, again, focusing on decoupling the word premium from cost. A lot of people think, oh, permanent life insurance premiums are so expensive, they're so high. In reality, what happens is that premium goes into a policy, and yes, there are costs and fees that are deducted to be able to provide the insurance coverage, but a good chunk of that, and in many cases, particularly with PPLI, the vast majority of that premium gets invested. And so what we mean by tax-free growth is that net amount that's going into an investment account inside the policy functions very similarly to an IRA. You can invest in bonds, stocks, private credit. You can trade. You can get in and out of things. There's no tax reporting. No one's going to send you a 1099. No one's going to send you a K1. You sort of have this pile of tax-free money that you have a lot of flexibility to allocate. And so that's one of the three, and I'll get to the other two in the next slide, really strong benefits of life insurance in general, and what comes massively into play when it comes to PPLI.
That's right. In addition to those tax benefits, we often forget to talk about the non-tax benefits because they're not quantitative. And so they can often be less salient and less compelling, but they're important to note for a family that's got growing net worth. And asset protection is the main one I like to talk about here. The money inside of this trust, while it's a life insurance policy, and especially once it's paid out and it's cash, is going to be asset protected. That can mean different things in different contexts, depends where the trust lives. It can depend on a few things, but assuming that we're doing like a run-of-the-mill South Dakota ILIT, where the assets are outside of whatever state the grantor's in, they're in South Dakota, Nevada, Wyoming. These places all protect trust assets very strongly. And what that means is that the benefits are not going to be subject to creditors. So if the family or the individual who's giving this money away gets sued or has some other liability for whatever reason, the assets in the trust are going to typically be outside of the reach of those creditors. Not always, and there's some nuance here, of course, but the assets are going to be more protected than they would be otherwise. We've got source of liquidity here. We've talked about it. I don't think it's really worth belaboring. Let's talk about trade-offs. You've hinted at this, Geoff, and I don't think it's complicated, but it's worth talking about how families think about this. When you set up a trust like this and you fund it, that money's gone, right? It's out of your estate. It's out of your possession. You can't use it anymore. And so you need to be prepared to take some amount of money and send it away. It's not going to be accessible. There are other kinds of trusts that we do, that you do, that we've done with clients where you do have access. You can borrow the money out of an ILIT, or in a spousal trust, the spouse can access it. Here, it's out of your estate, it's out of your possession until that big payout comes from the policy, and then it goes to your beneficiaries. And then relatedly, you have a loss of direct access. How do you talk to clients about those limitations or those just that fact of the world?
Yeah, it's in these discussions, there's always three three categories of decisions to be made. One is, do I do, there's the life insurance decision. Two is, what do I invest in inside the life insurance? And three, which is the most kind of hand wringing, is how do I own it? And this trade-off of not paying estate tax versus not having direct access is either a no-brainer for folks. Some people are like, it's so great that I'm going to be able to not pay estate tax, but I can't lose control of it. Some people are like, oh yeah, this is for sure a gift for my kids. I'm never going to need it. No-brainer to do, to put it in the estate. And we have a lot of clients that are kind of in between. They know they're going in with the intent of making this part of their estate and to protect and to fund an inheritance for their children. But they're also maybe young and they're newer to wealth. Like, man, if in 10 years, could I be able to pull this back? And so we always kind of like walk through that scenario. And usually 9 times out of 10, there's a comfort level of A, sizing it properly, and B, just getting comfortable with other pockets of capital or other ways to access the money in the future. And most folks, if they're doing this with the intent of doing estate planning, that 40% estate tax saving of a fairly big number usually trumps the lack of direct access. Again, assuming it's sized properly and it's done for that reason.
That's right. And fundamentally, I think the client service side of this, making sure that they're thinking clearly about what other money they're going to be accumulating over the years. Like you said, they're often new to this money, and it's really tough to kind of take the leap to assuming security. And it's always good to have a margin of safety and to understand, what if things go wrong. But these families at this level typically are secure and are ready to start irrevocably giving up some of these assets because they're just not going to need them. And that's a conversation that is often very successful, and people do come around when we're having it. I think
and a question for you in that same vein, Geoff, is we get a lot of folks also that are like, oh, I think this is for estate planning, but can I just do it in my personal name? I don't know exactly what I want to do, and could I move it into the trust later? We have our answer to that question in terms of, yes, you can, but you're going to be gifting a higher amount, and there's going to potentially be a clawback if there's an event after you do that. But do you run into that as well about kind of enforce policies to ILITs?
Yeah, it's the same answer, and we have done both with folks being clear-eyed about it. Actually, more commonly, someone will say, I already have a policy that I've been paying into for a while, and I'd like to use that, as opposed to, let me buy a policy and I'll think about it in the future doing this. With the first conversation, very often we'll talk to people and they'll in the end decide, look, I'll just get a new policy. As long as they're still insurable and it's not going to be too expensive, people usually come around to, I should buy a new policy and keep it clean. For the group that is thinking ahead and not ready to commit, I prefer that conversation to end at, we're going to just kind of leave you alone and revisit this subject in a year or two, rather than kind of mentally commit to moving a policy in the future, just because that's then mind share and anxiety and people's plans change. I think it's better to, once you're going to do this, to really commit to it and to be sure that you want to do it. And so when someone is in that position, we typically kind of just let them go about their business, invest with you all, do what they need to do on the capital allocation side, and then we'll put a reminder to revisit this conversation about trusts in a year or two. And that typically works, right? We have an ongoing, I don't know if it's a parlor game or just a tracking of a KPI where we think about what is the longest sales cycle we've had, right? The length between talking to someone and them doing a trust or doing something with us. And that number will grow as Valur gets older, right? We've been around for five years now. The longest we've gone between initial contact and first trust now, not with an ILIT, but in general, is about 3 years. So that's just an indication that people do come around to this stuff when they're ready.
Yeah.
And it's a really important insight for you, for us, for the advisors on the call, and maybe even for the potential clients too. If you're not ready for this now, I'm very confident that it's going to make sense at some point, given some parameters about your financial life. And so, don't rush it, but understand that we're here and we'll very happily talk to you a year from now when you kind of when it starts to make sense.
Yeah,
it's a good healthy way to think about it.
it's a big decision. It's theoretically it's permanent. It's for your whole life. And then I totally. Sometimes I'm in awe of folks that make the decision really quickly. I'm like, oh, you know what you want, you can strike.
Yeah.
And some folks, and I'm probably more in this bucket too. It needs to marinate for a little bit, and that's totally fine.
That's right. Yeah, totally fine. All right, life insurance. This is you, Geoff. Why don't you take it?
Cool. Yeah. So let's switch gears and focus a little bit just on life insurance. And really the goal here, because I think life insurance, there's certainly lots of material out there. It's a well-documented product. I'm sure all of you have been pitched it from one source or another over the years. This call it the next 5-10 minutes is really to highlight private placement life insurance to you all. And for a couple of reasons. One, it's a great solution for the kind of category of clients we've been talking about throughout this webinar so far. And two, there's a lot of misunderstandings about it from a sizing perspective recently. And I'll sort of start with that before we dig into the nuts and bolts. But a lot of what we hear when we bring up PPLI to folks that are, let's say, $10 million net worth, and is that, oh, I Googled it, or I asked my financial advisor, or I asked my friend, and they said, there's so much upfront fixed cost, and the minimums on the funds are so high, it doesn't really make sense for me unless I was worth 100 million. And so if you run into that as you sort of research PPLI, which I'm sure if you're on this call, you're into researching things, you'll find that. And I would just say that was probably true 5 or 10 years ago, but just much like the democratization of alternative investments that we've seen take hold over the last 10 or 15 years, private placement life insurance is also getting democratized. Most of the costs are percentage based on the amount of money you're putting into it. So there's not some big fat fixed cost that you're going to have to overcome. The main cost, which Valur has frankly solved for, was setting up the ILIT, and with a solution like Valur, which is why our clients love it, that's out of the way too, in sort of this pay-as-you-go structure. So I would implore you, it's definitely not for everyone, but I would implore you to not necessarily cast it aside because you heard somewhere that you need to be wealthier to do it. On the flip side of that, it is only eligible for qualified purchasers, which is a $5 million net worth minimum. And so, ILITs and PPLI go hand in hand because anyone thinking about estate tax planning is most certainly probably above that threshold. So with that as a backdrop, step way back and I'll get into permanent life insurance mechanics. So how does it work? Permanent life insurance works, again, much more like an investment account in theory. And I say investment account, not investment, because a lot of folks are triggered by life insurance as an investment. Life insurance is not an investment, but life insurance is an investment account. You pay premiums into the policy. You're using after-tax dollars to do that. So you make your salary and bonus, or you have your liquidity that you generate. You put that into the policy. That policy immediately has insurance coverage. So whatever the death benefit that we solved for that you wanted is in force immediately, despite the fact that you still maybe have many premiums to pay. And a good chunk of that portion of premium, and depending on how we structure it and what your goals are, almost all of it can be allocated to an investment account. And so that's step one. You put the money in, there's some fees and costs to structure it and to get the insurance policy funded, the insurance layer funded. But whatever's left gets invested. That investment grows tax-free. So it's like an IRA. I mentioned this before, whatever you invest in, and it can be private credit, private equity, venture, grows tax-free. So there's no taxation along the way. And you can borrow it. The trust in this case can borrow against this account at any time tax-free. So let's say you invest and it's got $1 million in it, and the trust wants to make another investment somewhere else. You can borrow up to 90% of that value, pay very little interest on that loan because you're borrowing your own money, and go and allocate it elsewhere. So it's tax-free in terms of the trust's ability to access it while you're alive. And then at the combination of this investment account, which has grown, and whatever amount of insurance that was purchased inside the policy, will transfer in cash, in whole, immediately upon your death, income tax-free, because it's insurance. And again, having it held in an ILIT makes it estate tax free. So to put a bow on all of that, the way to think about this is the money you enter into this structure, permanent life insurance owned by an ILIT, will never be taxed again. And it will never be taxed again income-wise or estate-wise even if the trust uses it while you're alive. So there's a lot of tax flexibility and tax alpha that can be generated through doing this as a structure. I'll move to and Geoff, I think you can control the slides. Yeah, I'll move to the next slide. So one question we also get a lot is, how does PPLI differ from traditional insurance? So what I just described is true of all permanent life insurance products, from universal life, whole life, private placement life, variable life. All of it has that same sort of tax construct. And the two main categories are retail, which is more, you're buying the insurance for protection. You want $3 million of death benefit, or you think you're going to have an estate tax liability of $5 million, so you have $5 million of death benefit. You pay premiums. There's surrender charges. The cash value account doesn't grow that much in the beginning because there's a lot of upfront costs and commissions. And the investment options within the policy are very similar to what you get in like a company-sponsored 401k. It'll be 50 or 100 different mutual funds, ETFs, and index funds that you can allocate. Still a great product, still can be designed to either protect you for the totality of your life or as a tax-free investment vehicle. But things to be aware of are it's more front-loaded from a cost perspective, which means it won't grow as quickly initially. And the investment options are limited. And if you are at the point where you have enough net worth where you're planning for estate taxes, you're likely interested in wanting to get access to alternative investments and not just be limited on these dollars for the rest of your life to invest them in public market ETFs and mutual funds. So PPLI on the other side is quite different. It's the reason you buy it is for investment growth. You're not looking for a big death benefit insurance policy day one. You want to put the money in, you want to allocate it to the investments you want to allocate to it, and you want that growth to occur tax-free and that to be kind of the driver for the decision. Nice thing about PPLI is it is not nearly as cost prohibitive in the beginning of the structure as retail policies. Upfront commissions are quite low, and the fee structure is much more akin to a managed investment account where you're paying a percentage of the investment amount on an annual basis. And so it really kind of smooths out the return. It allows for better growth in the beginning. The main reason I would say people gravitate to PPLI is that they want to buy alternative investments, but they don't want to deal with the tax inefficiency of alternative investments. And taking that a step further, endowments and foundations, which are these very famous institutional investors, they have 50 or 60% of their allocation, if not more, in these alternatives. And so the sort of going thing is like invest like an endowment or foundation. What you're doing from an estate standpoint is very similar. You're investing for some benefit in the future. The benefit they have is they don't have to pay tax on any of that because they're endowments or foundations. When you're a private individual and you buy a hedge fund that trades a lot, or you buy a private credit fund that throws off a lot of income, you're going to get a K1 every year, probably delayed, and it's going to be a big tax bill that you're going to have to pay as a portion of the return you receive, which then makes it really a less attractive investment option. However, these investment options do provide great diversification, low volatility. So if there's I'm posing this sort of rhetorical question of like, if there's a way that you could access these without paying taxes, that would fit a lot of folks' portfolio. And that's where things like private placement life insurance come into play. Yeah. So a recap to that, it's really, think about it like a way for you to access alternative investments tax-free and also have it be the seed or the full boat of an estate plan for your children or beneficiaries in the future.
That's great, Geoff. In the interest of time, while I show this this slide, would you mind just digging in for 30 seconds on those fees? Dave asked, and you touched on that slide, but you said it's an AUM-based tail for PPLI. what are we talking about actually for kind of?
Yeah, great question. So there's a couple different categories of costs. One is premium tax. So you pay a tax based on the amount of premium you put in. That goes to the federal and state governments of the the federal government, obviously, and then the state government of whatever state you're in. South Dakota is a very premium tax friendly state, which is why the South Dakota ILIT solution at Valur is a great match for this. You then pay a commission to the insurance agent, which is usually a 1%, let's call it, plus or minus, of the amount of premium that goes in. And then on an ongoing basis, you pay between 0.3% and 0.5% of the value of the investment account on an annual basis. So when you add all that up, year one, between the taxes and the commissions and the AUM, assets under management base fee, it might be a few percent, which is not insignificant, but it's less than what you'd get in a traditional policy. But when you forecast it over 30 or 40 years, the average fee of someone doing this that's 50 years old is somewhere in the neighborhood of 0.7%. So you have a cost or fee burden of on average 0.7% per year for the benefit of not having to pay any tax on the investments within it, which if you're buying the S&P 500 could still work, but maybe not as attractive because that's a tax efficient investment. If you're buying a private credit fund, that's a huge tax savings potential.
Which I think, and I think we can maybe jump over this again, given the time we've hit on all this stuff. Everyone who's watching and everyone who registered will get the recording. You can look at this slide. It's basically covered. I think that is a helpful segue to this kind of case study-ish slide. The idea that we're looking at the benefits of these different things over time. The tax advantages of this are significant, and as you can see, far outweigh the drag from fees. Why don't you talk us through what we're seeing here?
Yeah, absolutely. So this chart kind of gives you a few different paths for investing $250,000 a year for 4 years. So the assumption here is that $250,000 per year goes in for 4 years. The insured person on the insurance policy is a male age 45, which impacts some of the underlying costs in the policy. And we assume that the investment generates 7% annually. That's a pretty low number. A lot of what the alternative funds that we see in PPLI are targeting 10% plus and have delivered that historically. But with that math, you'll see that if you fast forward 40 years, that $250,000 times 4, factoring in all the costs of the life insurance and not having to pay any tax on that, becomes $11.9 million tax-free for your beneficiaries if held in an ILIT. If you did the same exact policy, you would still turn that payment stream into $7.1 million or $11.9 million income tax-free, but after paying a 40% estate tax, that nets your beneficiaries only $7.1 million. And if you were to say, I don't want to do life insurance, I don't want to do ILITs, I want to put the $250,000 a year for 4 years directly in alternative investments myself, taking some assumptions about tax rates and what the underlying investments are, but a standard alternative investment portfolio, after paying the tax every year along the way, the net amount is $4.9 million. So huge potential tax savings, particularly if done for estate planning purposes and put in ILIT, and if invested in alternative investments, which historically are tax inefficient. So that's sort of the trinity of this.
That's right. And I think there's a couple of interesting insights here that tie this all together. The first is, the first basic one is invest your money, right? Get the money into the markets. You're going to do well over time.
Yeah.
The second is, even if this isn't an estate tax play for people, the income tax savings from life insurance can be substantial, right? That's an important insight. And then especially for families that are going to be subject to the estate tax, you see the extra delta of doing this via an advantage structure like an ILIT. And you can end up with more than twice as much money if you do this right as compared to just investing in the markets.
Yeah.
So you're going to do well. You've got this money. It's great. Grow it to $5 million. But if you layer on top the life insurance and then the ILIT, we're talking about an extra $2 to $7 million on that initial $1 million invested, which is for even for the families at the lower end of the high net worth spectrum is, potentially, growing their after-tax estate by 25%, which is really valuable.
And a comment on real quickly on that, on sizing as well, because we get that a lot. Some people come to the end of this and like, wow, I can put a bunch of money and never pay tax on it again, and I can access all these alternatives, and a large number is maybe envisioned to do it, or let me just test it out a little bit. I would say that general guideline for us is 10 to 20% of your total net worth is kind of the spot to do it, where it's going to be meaningful for you. But you're not going to put so many eggs in the basket of a life insurance policy, which may be difficult to access.
And so we're talking about, for families with anywhere north of 5 million, you could do 20% on that kind of standard $1 million investment. And for families that are at the higher level, you could consider the separate managed accounts. You can talk about putting in more, maybe $2, $3, $5 million. But it's accessible, as you said, even to families that are, again, we're all talking about a lot of money here, but are on the lower end of the lot of money spectrum. Right?
Exactly. That's exactly right.
We've got one question. If anyone else has questions, please chime in. We've only got a couple of minutes left. I've got one that I want to show here, and this is just a clarification around the taxes on the premium that you mentioned in the previous slide. You want to just talk, if you can, just talk about what the concept, why that is.
Yeah, so this might not be an accurate comparison, but think about it almost like a sales tax in a way. You're buying an insurance policy, and the state and federal government take a very small percentage as what is called premium tax. So if you're going to invest $1 million in PPLI, there's a 1% federal tax. It's called a DAC tax. So $10,000 comes off that million to go to the federal government. And then depending on where the owner of the policy resides or is situs, there is state taxes as well. So as an example, if you're a California resident, you have a 2.3% premium tax. So on that same million, you have to kick in another $23,000 to the state of California. If you own it in a South Dakota, you're a ILIT or a South Dakota LLC, or you live in South Dakota. Still haven't met anyone that lives there, but if you live in South Dakota, then you pay 0.08% tax. So it's only a few $100s that goes to premium tax.
It's an underrated piece of the additional structuring that we do, right? So sometimes you might wonder, do I have to do this in South Dakota? Do I need to do it via an LLC? It's an extra $1,000 a year. Well, you're saving just on the taxes. You're saving enough to cover that, and then of course there's the additional benefits of doing it via the
tens of thousands of dollars potentially.
That's right. All right, we're at time. Geoff, I want to, I guess, here you've got our various URLs, our emails. Feel free to reach out to me, to Geoff, schedule a call with Valur, go to artafinance.com, and then come back for our next webinar, number 36 in the series on oil and gas, which is a strategy for typically ordinary income. Very different from what we're talking about today, but also valuable for the kinds of families that are looking at PPLI as well. So that's all great. Appreciate everybody taking the time. A couple of good questions. Geoff, incredible content, really, really helpful to dig into this stuff. Everyone, you'll be getting a recording, and you'll see this stuff up on our YouTube channel and newsletter and various other places. So Geoff, really appreciate you taking the time. Great as always, and we'll chat soon.
My pleasure. Thanks for having me.